Hi, it's Marco here. Can Gevo survive inflation? There are actually 4 things that Gevo can do to actually survive inflation. And the first one, and this is the interesting one, is to generate more revenue. And this is the bit of news that came out actually a few days ago. It is that Gevo begins startup of its renewable natural gas project. And that means, yes, you guessed it, more revenues, because that's something that Gevo has been missing. They've been making a little bit of money, but nothing meaningful yet. And so with this new project, they will be able to finally bring some cash in. And now we're going to look at how much this cash will be, because that's the important bit, isn't it? And again, no beating around the bush. The facility is expected to lead to 9 million to 16 million a year. And that's the distribution from a project expected to begin. And this is the timeline, guys. So again, no beating around the bush, expected to begin to produce in late 2022 or early 2023. So that's the kind of timeline we have for this plant. Now, Gevo is obviously gonna need more money, because only 9 to 16 million a year, that doesn't even account for the cost of the plant itself. But overall, even if we consider the highest number, the highest revenues that they are thinking of, 16 million, well, that's not enough to make Gevo a very stable company in the short run, making Gevo a very speculative play. But there are other ways that Gevo will use to actually survive this inflationary period. It's something that will have to be looked at later. And you know what is not speculative at all? Opening an account on BlockFi, and that will let you lend your crypto and get a whopping 8% return just by lending your stable coins like Tether, like USDC. And if you use the link in the description below, you would get $10 if you open an account and you deposit $100 or more, or you get $40 if you do not live in the US. But now let's move on to the next way Gevo can actually survive this inflationary period, and it's obviously to use their cash reserves. And again, no beating around the bush. This is their cash reserve. And what I wanted to emphasize is that most of this cash comes from non-revenue, like from dilutions, from debt, all sorts of things which we are going to look at later in the video. But to just look at the cash they have at the moment, it is about 136 million. That is based on the very last earnings report, and based on the latest number, if we look up, we see that more or less the amount of cash that is needed to run the business is about 20 million a quarter. So that's what we have to kind of play with for the short term. 136 million, 20 million for the day-to-day, for the quarterly expenditure. So that kind of covers it for the next 1 or 2 years. But as you know, Gevo is a business that is very much cash intensive. So to build their own production plants, they need a lot of capital, really a lot of cash. And that cash needs to come either from investors or from their very own cash reserves. And so looking for the very short term, like 1 or 2 years, they are covered. Probably they are covered, but they need to actually come up with other ways to actually raise cash. And the next one we're gonna look at then in the list is to actually raise more debt. Now for this one, I'm gonna use simply Wall Street. And if you look at this chart, this is debt, equity, and cash equivalents. So as you can see, the red line is debt, and these days the amount of debt that they have on the balance sheet is the highest they've ever had. And obviously we are looking at Gevo. So overall, you know, we seem to have a lot of debt compared to the past. But if you scroll down and if we have a look at, we have 66 million in debt, which is overall not too much considering the amount of equity that we have, and more can be probably raised. But let's think about that for a moment. We are about to enter inflationary times, probably even worse than we have seen so far, and not in terms of like increase of inflation on a month-on-month, year-on-year. We are looking at higher interest rates, which is what actually hurts the most when you have a lot of debt. And so by actually taking on more debt, we're gonna actually increase the risk for a Gevo investor like myself, like yourself. And by the way, if you want to know more news about Gevo, I make this kind of videos on a regular basis, and so you know that this is the channel for you. But just to look at the future, it's not a great idea for Gevo to actually go out and get more debt, because they would actually to end up paying a lot of interest, and that could actually become a problem in the long run. Which takes me to the next way Gevo can actually survive this incredible period of inflation, which is to actually dilute their shares, which is something they've done in the past. So let's have a look at the chart and understand what the risks are for this company. So I wanted to start from looking at Gevo from basically the last few months to see that the stock price has gone down like absolutely crazy down. But looking at basically what happened in the past, the price used to be much higher. So have a look at the chart yourself, because you see that what happened was that the stock was much higher. Then they've done things that I'm gonna tell you in just one second, and they kind of fixed their own kind of balance sheet and stock price. So what I wanted to tell you is that there is the potential for more dilution. There is no doubt about it. So in terms of the effect of this dilution could be a drop, basically. That's where we can actually fall. So how much lower can we fall? Well, just as a very much finger in the air kind of estimate, we can look at what the absolute minimum was for Gevo. So looking at July 2020, which was the absolute minimum price that we reached, it was basically around 40, basically half a dollar, 51 cents, which would be a massive, and guys, don't cry, don't think that I'm bearish. I'm just giving you the worst case scenario, and then whatever you make of it is up to you. There is an 83% drop from today's price. 83%. It's a lot. It's a possibility. I'm not saying that it will happen, but it could happen. But as you know, in 2020, the Fed came in and actually saved the day for everyone. Not just companies that were not profitable like Gevo, but also companies that were very much profitable like Apple, Nvidia. And those are companies I make videos about, like mostly Nvidia and AMD, because they have a lot of growth in the future. But basically 2020 is now unfortunately a far memory in our mind. And so can the Fed even come now and save the day? Probably not. That's the problem. That's why we have all this inflation. And so, for example, there is another thing that Gevo can do to save the day and potentially get through the toughest times that you can think of, even the worst inflation you can think of. But first, remember that Gevo is a very speculative play, right? So that's Gevo. If you don't want any risk, use the link in the description below, lend your stable coins on BlockFi, you get your 8% annualized. The other way Gevo can actually survive is a reverse split. And I'm saying this not just out of thin air. It's something that has happened in the past. So they had splits in the just normal splits in the past. So split 120, then there was split 120 over here. There's this one 2017, this one 2018. So there has been stock splits. So that's something that can basically happen in the future. So if the stock price would fall very low, let's say, as I told you, 51 cents more or less, and might even go lower, what Gevo can do is to do another reverse split actually, and basically the price of the stock would actually go up, and we will still be trading in the Nasdaq, which is a place where you have a lot of liquidity, basically making sure that the share could actually be further diluted, but at least the company will survive this inflationary time. Subscribe for more videos on Gevo. Thank you for watching.